I don't know, I probably have 10 to 12 properties that I acquired with no down payment and no interest at all. And so it
So you're
comes
paying
in.
only on principal. So you're literally just paying
Correct.
principal down.
Correct. That's exactly
Yeah.
right. Yep, that's exactly right. And the way that we achieve that primarily is in the frame.
Welcome to Entree Real Estate, where we turn the complexities of real estate into clear, actionable steps for building generational wealth. I've invested into different types of real estate all over the United States, and I run a thriving real estate fund. Join me as we document the entrepreneurial journey of scaling businesses and transforming the lives of tens of thousands of people around the world. Let's turn your real estate dreams into reality. Buckle up, because this is the start of something truly incredible. My name is Devin Robinson, and welcome to Entree Real Estate. What's up, and welcome back to another episode of the Entree Real Estate Podcast. Today's guest, really, man, I can't tell you, I'm such a big fan of this person. He's one of my favorite people in my mastermind that I'm in. I met him in. I really look up to him as an investor and just even as a person, as he just gives so selflessly. Out of who he is and the knowledge that he has, that he's been able to honestly do some really, really cool things in real estate that honestly is just a huge accomplishment at such a young age. I know he just got married too. We'll probably chat about all that stuff, but really, really just thankful to have you on and thankful for you just being even a friend, Tyler. And so thanks for being here today, man.
Likewise, Devin. Appreciate the warm introduction and right back at you, dude. I mean, you're one of those people that no matter how your day is going, as soon as I hear your voice, and you always manage to put a smile on my face regardless of what's going on. So appreciate you.
Oh man, I wasn't fishing for those compliments, but you hooked me. You hooked me. I appreciate you, man. Well, Tyler, I would love even just to hear a little bit about. This is an entree real estate. I call this entree real estate because the real estate journey, a lot of times people use it as like, oh, I just want to invest into real estate, but don't realize the entrepreneurial aspect of it, of growing a business and actually kind of doing that, which you've done at a really high level. You've come up with really creative solutions to do things, but you've also expanded into a bunch of other areas that typically people get a little bit, they get a little bit intimidated by. And so I'd love to hear kind of your journey. How's that journey been? Some of the stuff you've been involved in, and even just along the way, just kind of what that's been like. And we'll kind of dive in and we'll double click on some of that stuff. But yeah, man, I'd love to hear about you, where you're from, and kind of some of the stuff that you dabble in and where you are now, because it changes.
Yeah, yeah. So it'll be really, really interesting to talk about the entrepreneurship aspect of real estate because I come from a background that is literally the exact opposite of anything entrepreneur. So I was raised in a very traditional household. No member of my family has ever done anything entrepreneurial at all in the slightest. Entrepreneurship was never ever on my radar throughout all of college or anything ever. I was raised where I was told to get good grades in school so you can get into a good college and then get a good job, and then man, you'll put in those 40 to 45 years and you'll be living good at 65 years old, right? That's the household I was raised in, which I don't fault my parents for it at all. I was raised great and I'm so blessed for that. But what ultimately happened was I did do well in school. I went to a good college. I did get good grades. I stuck around for a master's program, so I got my master's degree in accounting, knocked out my CPA license, and then I got a job as an auditor at a Big Four accounting firm. And it was like, man, in the eyes of my colleagues and in the eyes of my family, like I was absolutely crushing it. But during that time, like specifically during grad school, I became obsessed with real estate investing, obsessed with it. That's when I found out about Bigger Pockets. And I didn't even realize people bought houses at that time. Dove into Bigger Pockets. I discovered that in grad school, and that's when I became obsessed with real estate investing. And so my intention was, I got my CPA license. I went through this hassle of, getting my undergrad degree, getting my master's degree, getting my CPA license, which took forever, man. It's a lot of work to do that. Then I got this big fancy job. Well, what I wanted to do was continue to work that job and invest in real estate on the side. What ultimately happened was I was getting up at 4:30 every single morning so that I could listen to podcasts, read books, read articles, everything before work, during the commute, during my lunch break, and then after work I was staying up late doing all the same thing. Ultimately, I developed this passion for real estate investing that I couldn't ignore anymore. So I actually found I was visiting some friends from college in DC, and they were like, "Man, have you heard what Will is up to?" Will is a guy that was actually pledging my fraternity while I was in grad school at my college. I was like, "No, what's he doing?" And they were like, "Well, he's doing something with real estate in Virginia Beach and apparently making a killing." I was like, "Okay." So I messaged this guy and I was like, "Yeah, what are you up to?" So we went out for dinner. found out what he was doing, which was wholesaling real estate, and he was doing really well. Me being an auditor, I was like, you've got to open up all your books. Like, I need to see everything. I hear what you're saying, but like, I need to see the proof in the pudding, right? So I literally went through this guy's bank statements. I went through his QuickBooks. I went through everything. Yeah. And I told him, I said, like, listen, man, I'll come and I'll double your business. I'll do acquisitions for you and I'll double your business. So that's when I disappointed my parents, told them I was leaving all that stuff behind in the accounting world, and I was going to go work for this. At the time, he was 19 years old. I was going to go work for this 19-year-old in his startup, doing acquisitions for him. And I did that for a year, and then he moved to California, and that's when my business was born, and I was kind of thrust into entrepreneurship. Okay,
so this is really interesting. Do you think, because I'm fascinated in this, do you think because of the way your mind is, and you got an accounting degree, worked at an accounting firm, that for you were really excited about it. You love the idea of investing, but until you saw essentially you saw the proof of concept, that's when you actually decided to dive into it. Is that because you almost like not reverse entrepreneured, but you said, hey, I'm going to, and this is actually the way I think it should be, but you said, I'm going to go work for somebody, learn from them, and then out of that became your own thing. Now, going back a little bit, do you feel like the proof of concept is what really drew you into the business? Because you had to see the books, but you were passionate about it. Without seeing the proof of concept, do you think you would have actually done it?
I think so. Yeah. I think it would have taken me a little bit longer, but during that period of time, I knew that if I didn't go all in on me, so like in the corporate world, a lot of times what they'll do is they'll put kind of a glass ceiling over your head, right? Mm-hmm. Ultimately, that's what happens. They kind of cap your upside. You have very limited downside, but you have equally limited upside a lot of times. Mm. And so during this period of time, I had such a strong passion for real estate investment that if I didn't take a swing on myself and go all in on me, and I got to the end of the road and never took that swing, I knew that was going to be a regret for me. So a big one that I was going to have a hard time accepting. That's what I call a deathbed regret. So a lot of people will put off deathbed regrets for a long time. This was one that like I could not ignore. I couldn't wait. And I felt like, like God presented this opportunity to me for a reason.
Okay. So for you, you mentioned deathbed regrets, just something I want to kind of like touch on. For you, it sounded like not taking that risk you believe would have been a deathbed regret. Do you feel like your deathbed regrets come in hindsight, or do you have certain ones that you're like, if I will do this before I die? Like, what does that look like in your life as you continue? Because I know that that's something that you continue to evaluate in your life and think through and process through, and make sure you live your life essentially with the purpose of accomplishing or living out. So what does that look like for you, man?
I would say some of them ahead of time. So like the real estate one probably didn't know until I developed that passion. I mean, I didn't even know you bought a house for investment purposes. As embarrassing as it is to admit, like realistically, that's what it was. So I developed this passion, and I was like, I've got to take a swing on this thing. So that deathbed regret didn't come to my focus and my intention until I developed that passion. But then there's other things like my wife. My wife and I, we were both born and raised in Virginia Beach, Virginia, and we lived there our entire lives. Even for college, I only went to college, it was like an hour away from where I grew up. So she and I were both looking at it going, man, if we don't live somewhere else and go experience something else, like we know we will always regret that. That was a deathbed regret, a very predictable one, a very foreseeable one. Kids, same thing for both of us, for both my wife and I. We don't have any kids right now, but we know that if we got to the end of the road and we didn't have kids, that would be a major, major regret for us for sure.
Yeah. Okay. So speaking on that, at what level do you then, because those regrets can also seem fairly entrepreneurial. Like for you, you took a fairly entrepreneurial risk in your deathbed regret of traveling and like not just staying in Virginia Beach. It is a risk to go out and just kind of figure things out. And so for you and your wife, you currently, just even in your current context, recently, because currently you're now reside in Colorado, but you recently decided like, screw it. I don't want to die not doing this. And so what was that journey like for you guys in traveling and figuring that out?
So we didn't flip a switch and say, okay, we're going. That wasn't the way
Okay.
it worked. I designed the business to support that lifestyle. So what that looks like is we have an incredibly strong foundation backed by KPIs that we look at and monitor on a very, very close basis. And then the biggest piece that I had to develop to be able to leave was I could not be running all the appointments anymore. So I'd say like up until January of this year, I was responsible for pretty much all of our revenue. I was running all of our appointments. I had to go out and I had to find reliable acquisition people that I could train and develop to be able to replace me. And so that's what I've done. We have a pretty good acquisitions team now, and I tested it before we left, so we didn't leave until the last week of April from Virginia, and I spent February, March, and April running 0 appointments to see how the business stood up, and it stood up really, really well. So then, when we moved that first week of May, well, the first day of May, I guess, here to Denver, nothing changed. Nothing changed at all. So, it wasn't just the flip of a switch. It was a very intentional process to build the business, to support the lifestyle that my family wants to experience.
Nice, man. So we're gonna kind of dissect a little bit of that now, but I want to stay on the journey part. So what did y'all plan to do? Right? You just said, so you created the vehicle in which that allows you to do the traveling or to fulfill out the deathbed, to not have that deathbed regret. So you and y'all decided to what? Like, you sold your house, and then what, did y'all have a plan on a final destination or anything like that?
No. So the plan was actually, we were supposed to stay in furnished rentals on a month-to-month basis for 60 to 90 days at a time in what we had picked out, like 5 or 6 different cities. And at the end of that journey, we were going to determine, does it make sense to go back to Virginia or to, stay in a place that we visited. And so we started here in Denver and then fell in love immediately, like in like the first few days. And so then we turn around, we signed a 9-month lease here, which is really funny. We're still going to visit those other cities, but we're going to do it on like a week-long vacation as opposed to a 2 to 3 month stay. But
What are those other cities?
Yeah.
What other cities?
Salt Lake City, Bozeman, Montana, Coeur d'Alene, Idaho. We were looking at Cody, Wyoming, which sits on like the border of Yellowstone, which is really, really cool. Bend, Oregon, and then we were toying around with the idea of Seattle.
Okay, nice. Okay, so you stayed almost like northwest of the
Because
US.
that's where we've spent the least amount of time.
Oh, okay.
Yep.
Sweet. All right, I love it, man, and then decided to stay. Now, I'm very curious. Are you going to try to invest some in Denver while you're there, or even figure like what you want to do there, or is it just like, no, stay where you are, kind of do what you're doing, and then move on?
My sole focus is still in Hampton Roads from an investment perspective. I'm doubling down into our business every single day. If I did do anything in Denver, I think I would go after something that you and I are very passionate about, and that's pre-foreclosures, and see if there's any fruit there. So that's not a right now thing, but that is a potential thing.
Nice, man. Okay, cool. Now, just to kind of backtrack a little, you talked about the things that allowed you to sustainably remove yourself from your company are focusing on KPIs, and then you mentioned like removing yourselves and training up people. But what you didn't mention was probably having really, really airtight, proper SOPs, processes, systems in place to be able to make yourself reproducible at scale, to not have to be in the business. Because if you don't have proper systems, then you won't have the consistency, and then you keep jumping back in your business. So I'd love to talk about even what that process was like for you. Like, one thing I heard was this guy, he owns like 200 businesses or something, but he's like, all I do is I look at one number in each of those businesses every week, and I can tell if I need to jump back into that business based off of that one number. And so for you, when it comes to your KPIs, what are the really important numbers for you to manage and monitor so that you don't feel the need to jump back into your business if those numbers are healthy? Does that make sense?
Yeah, it does. And it's pretty simple. I'd say there's I think it's 6. So there's leads, net leads, appointments set, appointments attended, contracts signed, and deals closed. That's
okay.
it. And so those are the main, that's like the lifeblood there. And if one of those kind of tampers off, like it's very evident where we need to jump in, what we need to tweak to get things running back to normal.
Okay, now your KPIs, they sound heavily acquisition focused. Do y'all wholesale a lot, or are you keeping a lot, or like what's the disposition side look like then? If like because that seems very, and understandably you don't have, if you can't get deals, you can't sell deals. So I understand like the importance of having the acquisition side, but what's like the disposition model for you that you feel so comfortable that like that's not necessarily something you worry about?
We keep a lot. We keep a lot. Yeah, we keep a lot. The stuff that we do disposition, we typically disposition via MLS. So, you know, I don't, in the current state of the market, at least in Hampton Roads, Virginia, we haven't had a major issue dispoing stuff. So, to be honest with you, I've had my finger off the pulse of that one a little bit, just because typically whatever we list, it sells extremely, extremely quickly. The acquisition side of things, that tends to get a little bit more sideways, just because right now, given the current state of the market, it's a little bit more difficult. It's a little bit more of a challenge to find those discounted properties.
Nice. Yeah. So now this is where not my first introduction, but my first understanding of your expertise was like, yo, Tyler is the guy that gets creative financing deals and he doesn't pay a dime for them, like, ever. And I was like, what? There's no way this man is not paying. This way, this guy's getting 0% interest and zero money down seller financing. And so, like, I'd love to double click on that just a little bit, because I think that's extremely fascinating and something that you never hear. Because if you're in any kind of creative financing group, the structures always come with like 15% down, 4%, and it's like, sheesh, like that's not even a deal. But you're getting deals and you're like, I don't pay anything for my deals. And I distinctively remember driving from basketball, sitting next to you in a van, and you explaining this to me, and I was like, what the heck? And so I thought that was like insane. So I'd love even if you just kind of like touch on that a bit, because I think it's really, really helpful and informative and wild.
Yeah, it's really interesting. So, and that's something that, in my opinion, is recession-proof, because the power of interest-free and no money down real estate is, if you have a house that's worth $100,000, I will pay you $2 million for it. I'm serious. Like, price doesn't matter. I just need you to hold a note where I pay you $50 a month for the next 200 years. Are you good with that? Right? Like, that's an extreme exaggeration. But yeah, so I probably have 10 to 12 properties that I acquired with no down payment and no interest at all. And so
you're paying only on principal. So you're literally just paying principal down.
Correct. That's exactly right. Yep. That's exactly right. And the way that we achieve that primarily is in the frame. So as long as we frame our conversation correctly, when we talk with sellers that, you know, seem to be a fit for seller financing, these are people that say stuff like, look, I don't need to sell. You know, they seem to be price sensitive. I'm sure you guys have heard this kind of stuff before, right? Like, oh, if you can't give me such and such, don't bother. Those people, like, someone should start to go off here. Like, okay, they might be good for creative finance. So when they start to go down that route, I just say, well, look, you know, good news for you, Mr. Seller, is unlike most investors, the people that I've typically worked with, they want to sell. They don't have to sell. They're actually, you know, they're typically just interested in netting the most they possibly can out of the sale, and they don't need the money. And so when you say that, just think about it. When you say that we work with people that want to sell but don't have to sell, they're like, well, yeah, that's me. Mm-hmm. Then you say, and people that want to net the most they can out of the sale, who doesn't want to net the most they can out of the sale, right?
Yeah.
And then when you say, and people that don't need the money, well, that's an ego play. So now that seller is saying, well, I don't need the money either. Like, I'm good. Okay, sweet. Then let's talk. And so a lot of people try to overcomplicate the seller financing talk. Don't think it needs to be that complicated. They do. All we have to do is, Mr. Seller, is agree on three things: price, monthly payment, and the timeline. All I do is make you that agreed upon monthly payment over that timeline. And during that period of time, I'll take on any and all responsibilities that have to do with that house. And then
you know, I was thinking you could at least put down a down payment. And what about interest?
Oh, we don't do down payments. Like I said, the people that we work with, they typically don't need the money on day one. Instead, they're more interested in netting the most they can out of the sale. And so, Mr. Seller, by eliminating a down payment, it allows us to offer so much more.
Okay, that makes sense. Man, that's awesome. That's insane because like that's what people worry about. They worry about somebody coming back and going, "Well, what about a down payment? I want some money down and I want some no, I'm not going to do this on interest." But not because like they need the interest, but because they feel like that's just the norm. That's what happens. And so when you set it up like, "Oh, we typically work with people that don't need," because like, and I think we talked about it. It was like, so essentially I could pay you more over time because I don't have to worry about an interest payment on it or something like that. And now
Yeah,
you do say sometimes you're like, well, if you want to, I do interest, but I'd have to come down in price, right? That's kind of how you lay it up.
That's exactly right. Yeah. What's more important to you, to have interest? If you want to have interest, to be honest with you, I don't really care. I'll just pull down the purchase price. If you want to leave interest out of the equation, now you don't have to report interest income, and we can offer a higher price. But it's totally up to you. I'm just saying, like, the people that we work with, they want to net the most, and I'm telling you how they achieve that.
Boom. Drop the mic on them. Get the deal signed. And
Yes,
this is
sir.
really awesome because like a lot of people, they don't know how to structure it. They feel like, oh, this guy's asking too much money. I can't meet that demand. This is a dead lead. And they don't understand that. Now, in order to do that, you might be like, no, Devin, that's not true. And we kind of flip it on to like a wrap conversation. But like people generally are like, you could seller finance if they own the house outright. So with you, passionate about, same here, we primarily only do foreclosures. You ain't seller financing nothing in foreclosures because they don't own the property outright. But you could theoretically sub to their current mortgage and then wrap the seller finance note as well if you wanted to do that. But are you, if let's say you want to do seller finance, do you ever do any kind of seller finance if they don't own it outright?
Sometimes, but it takes place. So we just closed on one. It was literally yesterday, actually. Took the property over sub two at, I think she owed like 85 grand or something, and she wanted 100, so that left like a $15,000 delta of her equity that we had to pay her. So instead of giving her that all up front, basically what I said is like, hey, would you work with me? What we can do is we can pay you in $500 monthly increments over the next, X number of months until that's paid off. And that the $500 payments are principal only, no interest.
So for you, for the deal to have to make sense, her 500 plus the bank's 70K mortgage note has to still be under what you're going to rent it out at to cash flow still.
That's exactly right. Yeah, that's exactly right. And some people have like a certain like strict rule on the minimum cash flow they'd accept. I look at it on a property by property basis. I mean, if it's a $300,000 house that I get in a nice area that I get significant depreciation on, I'll be a little bit more lenient on the cash flow I'm willing to accept. Or if it's a property in a bad area, maybe I'll be a little bit more strict. Like, hey, like this thing needs to cash flow extremely well. I'm a little bit more lenient with it. Some people are like, if I'm not getting 300, I won't look at it. Just depends. It's a preference thing.
Yeah, interesting. Do you ever evaluate your properties on like cap rates? I was listening to somebody on a earlier, and they were like, it's very interesting because single family houses are like disproportionately bid on at comparative pricing rather than cap rate pricing, which is really interesting to think about because like if it makes money, then it's a deal. But what we do is we compare it to other properties in the area to see if it's a deal when that's not necessarily how you do multifamily or anything like that. And so even going into that, we'll talk about some mobile home stuff because that's evaluated on a cap rate. And so
Correct.
I'm curious on your thought process on that, even just around that conversation that I just laid up.
I do not do cap rates, but what I do, and again, right now we're focusing on like subject to financing. We're leaving seller financing out of it because with seller financing, I don't care about the price. So subject to, I do care about the price. I'm an extremely conservative investor. So like it not only has to make sense as a rental for me, but I have to be able to exit that property in case something went crazy. So like I will not take on a property sub 2 that has less than a 10% equity margin because with a 10% equity margin, I'm confident that I can exit that property at a comfortable number and be totally okay. So I take a look at...
that's changed. You told me 40% recently. I was like, sheesh, 40%?
I don't know. It was, I don't know if it was 40%. If I told you that, maybe I was exaggerating a little bit. But there for a period of time, like when the market was uncertain, I was not doing any long-term sub 2 holds. So maybe that's what I was talking about. So like anything I took sub 2, I was only using it to flip. So like I would take it sub 2, make the payments while I was flipping the property and then selling it. Now I have like a more positive outlook on the market that I feel more comfortable sliding into these long term. And so now I've upped it so that if we're at a 90% LTV, like I'm okay, let's hop in, let's do it. So I need that equity margin, and then I take a look at what's our monthly cash flow and then the ROI. So like if I have to come with cash out of pocket, like I'm really looking for at least 20% cash on cash return there.
Okay.
Yep. And then sometimes I know you use a lot of private money. I do the same thing, especially with these pre-foreclosure sub 2s, is I'll borrow the private money for the cash that I have to bring to the table. So then we have infinite return. But that's what I look at.
Yeah, no, that makes sense, Ann. Now, there's a reason why I call you Mr. Two-Time, because you're one of the only people to win 2 Collective Genius hot seat belts, one on your creative financing, zero money, zero interest talk that you gave, but also the other one on just almost like it seems like it doesn't, I mean, maybe not an extreme pivot, but on a pretty like drastic pivot to almost not primarily, but like a heavy focus on mobile homes, which a lot of times people just view as like throwaway assets. Like it's not very, like, why would you invest in mobile homes? And so for you, like, what the heck made you want to invest in mobile homes, and like, is it worth it?
Crazy, man. This was incredible. So I told you I was obsessed with Bigger Pockets there when I was in grad school and stuff. And man, I listened to every single Bigger Pockets episode, sometimes multiple times. Well, one time, this was so early on when Brandon was first getting started, like literally first getting started with Open Door Capital, which is now like his humongous firm that owns, dude, I don't even know how many units now. They're trying to get to like 1 billion units, I'm pretty sure, or something
Units.
insane. Maybe not units. I forgot what it is. They have a crazy mission, right? I think it's $1 billion in assets under management is what I think their goal is.
Okay. Yep.
But anyway, so this was in the grassroots stage of everything. He put out an ad on Instagram basically saying that they were looking for people to join their acquisitions team for off-market mobile home parks. So I applied. Lo and behold, I got it. I was one of like 25 people that got it. So basically what we were cold callers. That's what, we would just cold call mobile home parks. But what I got was I made a few great, phenomenal connections in that experience, one of which connected me with CG. Like that's how I found out about CG, was working for Brandon.
Nice.
There was one time my wife and I went on vacation to Maui, and I got to meet up with Brandon because I did this cold calling thing for him. So I got to meet him in person. But the biggest thing was that I learned about mobile home park investing. I learned what makes a good mobile home park, how do you run the numbers, where do you look for them, how do you find them, all that kind of stuff, how do you negotiate them. So I had this blueprint in my head on what makes the most ideal mobile home park. Well, I got to the point where, at this point I was running a successful single-family wholesaling business, and I was like, let's take a stab at this mobile home park thing, man, see if I can't mess around and find one, right? So I did. I figured out how to, I built a list of mobile home parks basically by virtually driving for dollars with a virtual assistant. And I got 3 under contract, 2 of which I kept, 1 of which I wholesaled, and we made $100,000 on the one that we wholesaled, which is pretty awesome.
Sheesh. That's awesome. Yeah. So you mentioned a couple things. One, I just think the importance of like, now you didn't work directly like under Brandon, but almost the importance of like honing your craft by working under somebody, or by like mentorship or by apprenticeship. Just like you went and grinded it out for somebody else's company that then ended up benefiting you tremendously, like tenfold of whatever you made working for him because you learned the craft, you learned what needed to be done, how to underwrite, how to do all of those things. So what are like the basic things you look for? So there's 2 parts. Very curious on how, like, what the heck is virtually driving for dollars if you're not actually doing it? What does that look like? And then 2, like the basic things you look for when underwriting a mobile home park, or like, what do you look for? Because like people will be like, that mobile home park is 20 years old. Don't even worry about it. Like, now I know you don't just buy the mobile homes, because that's just buying an automobile. There's things to look for. And what would those be?
Okay, so first off, virtually driving for dollars. This is something I do in the single family business as well. But man, it's as simple as, there's different tools that you can use. I know my VA just does it right in batch leads. You can do it within batch leads. They have that built into there. With the mobile home parks, she was on Google Maps, satellite view from like the top looking down, and she would cover the entire MSA. And with mobile home parks, if you think about what they look like, they're like these, it's a bunch of shiny silver rectangles aligned in like a neat row. So it's very, very easy to identify what a mobile home park looks like from an aerial view. And with mobile home parks, a lot of them are mom and pop owners that put their freaking phone number on the front sign of the park. So the skip tracing part of it is you find the mobile home park from the front, you get the little yellow guy, drop him down to the street view, and that's the phone number that you need to be calling. I'm dead serious. I'm not kidding. All three parks that I bought were just like that.
I believe you.
Yeah. So that's virtually driving for dollars. What do I look for in a mobile home park? A few things. So for one, I like to own the land. I hate to own the mobile homes.
Yep.
I do not like to own the mobile homes. They are very high maintenance, typically a lower tenant class. In my opinion, it's the high grief, low net way of doing things. So what we do is the first park I acquired we owned all the mobile homes. So let me back up real quick. There's park owned homes and there's tenant owned homes, right? Tenant owned homes are what they sound like. That's where the owner of the mobile home park owns the land and the tenants own the individual mobile homes. Park owned homes are where the mobile home park owns the land and the mobile homes. So the first one that I bought, they were all park owned homes. We ended up seller financing pretty much all of them except for the ones that were in pretty good shape. The other one was this beautiful park where we just own the land. The tenants own the mobile homes. They're responsible for all the maintenance. In that case, all we do is we cut the grass, we pay for insurance, we pay property taxes, and we have like 2 lights in the park that we pay utilities on. Aside from that, man, you're just collecting rent.
That's crazy. So what does it look like though? Where do you get your money out of it? So like, how do you add value to something that is just, if it's not park owned, but it's, like, so where's like the value add and how you get the over time? I mean, like, is it appreciation in the land or maybe the amount of rental that comes in?
All right, this is the craziest part, man. This is the craziest part. All right, so when you've got tenant-owned homes, they pay what's called lot rent. So they pay you monthly rent to live on their park, or to live on your park, right? Like you mentioned earlier, mobile home parks are evaluated on a cap rate, which is based on how much income that the park produces. Yep. So the way that you increase the income for the park is you either decrease expenses or you increase rent, right? Well, when you increase lot rent, the tenant, you have unfair leverage as a mobile home park. I'll just put it that way because their options are they either pay the increased lot rent
or they leave.
But it costs on average like $7,000 to $8,000 to move your mobile home.
Oh, sheesh.
And most of these people don't have that kind of money. So like there is a major ethical component that comes into play here. But just to walk you through the numbers. So like we had the first park that we bought, it's like a 38 pad park. The lot rent was $160 a month. Market lot rent in that area is $350.
Sheesh.
We didn't want to beat them upside the head.
It's an instant value add just by adding $100.
Correct. But so what we did is we didn't want to increase it all $190 a month at once. So we increased it by 90, right? So if you take $90 a month times the 38 units times 12, and then you can, divide that by, let's just say it's a 10 cap, even though I really think this would trade at a 8 cap. That's a $410,000 value add that we experienced in a 30-day time span by sending out 38 letters in the mail saying, hey, your rent's going up. I'm not kidding.
And like they can't really do anything about it unless they just want to move. That's crazy. So, yeah. So what was like, okay, so I'm curious. So you seller financed it. Would you mind, you don't have to share, but like, what are the like round about numbers of a mobile home park? Are we looking at $1 million? Are we looking at 500,000? Like, and then if you seller finance it, is it at like, 38 times, I mean, like, what does that look like on the round basic numbers of how much you could potentially make on seller financing a mobile home park?
It's tough. So like in that one we actually bought with bank financing. That was just a traditional purchase. But so that was 38 pads. We picked that up for $440,000 At the time
Wow.
of purchase, it
Which
appraised for
is you
six.
literally make 100% of your return on year one.
Well, it appraised for 600, like for our loan before we
Well, there
did
you
the
go.
value add. So yeah, it was more than that. Like I said, that one was a steal. That one was insane.
Yeah,
That one was insane.
that's
So
awesome.
yeah, I would say like in terms of valuing it, like similar to apartment buildings, you typically have like an underwriting spreadsheet. What you do is you map out the current financials and you map out what the future is going to look like based on your value add strategy, right?
Hmm.
And then the big component of that is figuring out like what cap rate would this asset trade at in this area. What you can do is reach out to brokers, take a look at comparables, all that kind of stuff, and figure out what are they trading at, and you use
Hmm.
that figure within your underwriting to figure out, how much can I afford to pay for this, and it makes sense.
Yeah.
But so like that one, like, I'd say we're comfortably in like a $600,000 equity position on a $440,000 purchase, which we have zero money into. So we got bank financing for 80% loan to value on that, or loan to cost, not loan to value,
Nice.
loan to
Oh,
cost. And then we went and grabbed a line of credit for the remaining 20%.
oh, great. I was gonna
Yeah.
say, okay, so nice, man. So, did you grab that line of credit? Was it just like a small local bank?
Yeah, it was a small local bank. Yep.
Nice.
Yep.
Very
And then
cool, man.
we can talk about the other one we actually did acquire via seller financing. That was a 18 pad park, $250,000 purchase price. We did have to give a down payment on it, but that's because he owed 17 grand on his previous note. So we just covered that remainder.
Nice.
That one we did pay interest, so he agreed to drop the price from 275 to 250 so he could get 3% interest, but that'll be paid off in 10 years. So I'm just saying like it's like the power of seller financing is unbelievable.
Yeah.
Unbelievable.
That sounds incredible because you get to make whatever you want it. You get to make it whatever you want it to be.
Yeah.
That's awesome. I really do think that there's going to be a really unique niche, a really, really, really unique niche in two things. I'm giving away the secret here, but one, I think in like seller financing businesses, just from people who are retiring, and then like boutique hotels. It's just insane. So I really do think seller financing, if people can understand that, you can leverage seller financing in a ton of different markets and mediums and vehicles in order to make a good amount of money. So that's really cool, man. Really, really cool. Tyler, like so much information, so much knowledge here, man. Is there anything else that I mean, like, and I think we talked about it briefly about kind of the deathbed, the deathbed regrets, but is there anything else that you would want to leave the people with that if we didn't mention today, you would be like, dang, I really wish we talked about that? Or do you feel like we covered it all? Cause like, you've been killing it, man. This has been awesome. The amount of knowledge you've given you've been dropping some bombs over here. This has been good.
Appreciate it. Appreciate it. No, I mean, we did cover a lot. I guess the only other thing I would say is like, think about, just always be thinking about what's the biggest lever I can pull. Like, what one move can I make that would give me the most leverage? So, just thinking back to my journey and like what made truly a life changing impact for me was, finding the 19-year-old that was doing wholesaling that I could learn from, right? That was a huge, huge lever that kicked me out of my comfort zone and made me take that plunge that I was scared to do. And then like, had success with the investment business, the wholesaling business. And then I bought a mentorship on creative financing. As soon as I did that, I built this portfolio that I didn't have to put any money into, right?
Yeah, you bought like 35 of your own properties that you now own and rent out seller financing in 1 year, right?
It was probably, so I would say it was like 35 units over a 1 year period is how I would phrase that. And like right
Awesome.
now we're up to 78 units, most of which were acquired creatively.
That's
Yeah, most
freaking
of which
awesome,
were.
man. So
Yeah.
cool. I love it, man. Oh, man, that's awesome. And I love that idea. I love that thought of, man, just like pulling the levers that are really going to be the most beneficial for you down the road, especially if you already know what your deathbed regrets are. What will keep you from making those regrets or having those regrets? How can you pull the levers to alleviate that? So, man, so incredible. Yeah, thank you so much for sharing. There's a ton here, and I appreciate you. Tyler, where could people find you, man? Where can people keep up with you? Maybe even ask you some questions, follow along this journey as you gallivant around Colorado.
The best place to find me is going to be Instagram. I'm kind of like a teenager, man. I can't stay off of Instagram. So I'm on Instagram at Homebuyer Tyler. That's going to be the best place to find me.
Perfect. Homebuyer Tyler. Homebuyer Tyler. Perfect, man. Well, I appreciate you. I'm thankful for your time and your friendship, man. And
Likewise.
if you, just thank you so much, man. I hope you have an amazing day.
Thanks, bro. You too.
Yes, sir.